The Reserve Bank has recommended that the MPC or the Monetary Policy Committee's mandate be continued and at an inflation target of 2 to 6%. Now, here's the backstory. Reserve Bank became an inflation targeting central bank in 2015. That year, RBI and government signed an agreement setting up an MPC with 3 external members, 3 RBI members, and this MPC was to set interest rates in such a way that inflation remains at 4% plus or minus 2%. That is, CPI should be between 2 and 6% at all times. This mandate was for 5 years, and that 5 years ends on March 31st. Now, Reserve Bank wants the mandate extended as is for the next 5 years. Should the government agree? Joining me to discuss that are 2 economists, Sajid Chinoy, the chief economist at JP Morgan India, and Niranjan Rajadhyaksha, the research director at IDFC Institute, by far one of India's best financial columnists. Gentlemen, thank you very much for joining me. I have had opportunity to discuss this before with some other economists, but I got a message from the high and the mighty at Reserve Bank saying, why have we not heard from Sajid and Niranjan? And so this is going to be seriously watched. Okay, with that preface, Niranjan, first to you, and this is a half volley. Do you think inflation targeting has succeeded?
Not so much a half volley. It's a very complex question. But first of all, thanks, Ada, for inviting me on this show and especially sharing time with my dear friend Sajid. So, a short answer is that the initial 4 or 5 years of inflation targeting, I would say, has been a success. And I mean it in 2 or 3 ways. First is undoubtedly inflation has come down, has trended down over these years. There have been ups and downs. Now, a lot of people will respond to such a statement by saying that, well, this was an exceptional time because food prices were under control, global oil prices came down. But if you strip these and just look at the trend in core inflation, even core inflation has moved down substantially, which is, everybody says, is the most sensitive to monetary policy. So I think this declining trend in inflation, at least to some extent, the RBI has to be given credit for. The second thing I think, which is not focused upon that much in the debates, is that the gap between Indian inflation and international inflation has also narrowed. You see, especially in the years between, say, 2010 and 2013-14, we were a complete inflation outlier, right? The rest of the world was fighting with deflation or just very, very modest inflation, and we were almost towards the double digits. So I think that has narrowed, which tells you a lot about macro stability and the management of the economy. So in terms of these 2 simple measures, which is core inflation trend and the differential between Indian inflation and international inflation, I think we've done well. And then obviously there are changes in inflation dynamics, which are more statistically sound methods. And Sajid himself has done a lot of work on it, which also shows that the inflation dynamics in India have changed for the better.
Okay. So basically you would say that would be one good reason to continue. But Sajid, the charge against it is, have we paid a price for it? Distinctly, growth has slowed down, at least after 2017. So would you say this price is too much and therefore growth should be given a higher position for the MPC?
Thanks, Lata. It's great to be here with Niranjan. I think we just need to go back to first principles here. And I think the lesson over the last 50 years from emerging markets to advanced economies around the world is fundamentally in the medium term, there is no trade-off between growth and inflation. And I think that's really fundamental to inflation targeting. That the best service that monetary policy makers can pay to growth in the medium term is to keep inflation well anchored and contained, because we know high inflation is volatile inflation. It creates macroeconomic uncertainty. It vitiates the investment environment. It puts downward pressure on the rupee. So let's be clear that in the medium term, there is no trade-off between growth and inflation. I think your question is more in the short term that, can there be a trade-off? And my point is we forget the F in the FIT. We forget the fact that this is a flexible inflation targeting framework where the central bank focuses through its Taylor rule both on the gap between inflation and where it should be and the output gap. And if anybody had any doubts that we're not just paying lip service to the output gap, we simply have to look at 2020. 2020 was a year where, in the pandemic year, average CPI inflation was 7%. Despite that, because output gaps were so large, the central bank did not hesitate to slash interest rates, inject a lot of liquidity, significantly ease monetary conditions. And this was accepted across the board. Nobody doubted the RBI's inflation credentials because they had responded to the output gap in a crisis-like situation, despite inflation being above target. Risk premia and swaps never went up. Risk premia and bonds never went up. The rupee never came under pressure. So I think we underestimate the flexibility that the existing framework accords both to handle growth shocks and inflation shocks. And finally, I think we give monetary policy too much credit when we say it is responsible for growth outcomes over any medium term. Any amount of research has found monetary policy can handle, can either accentuate or dampen shocks around some trend growth, but it really can't fundamentally affect that trend growth. That's affected more by productivity, reforms, allocative efficiency. So I think for all those reasons, we need to step back and say I completely agree with Niranjan that I think we're off to a very good start. The pandemic year was exceptional, and one way to judge the efficacy of inflation targeting, apart from the evidence Niranjan provided, is just to look at inflation expectations, because ultimately that's how inflation targeting works, by anchoring inflation expectations. And what you will find is, if you look at either professional forecasters or household inflation expectations, they're much less driven now by past inflation. So the adaptive nature of those expectations has reduced, which is some sign that expectations are beginning to get anchored. Now, this is still a job that we've just begun. We need to anchor those expectations lower. And one very final thing I'll say, Lata, even if there is a cost that one has to sometimes pay, what economists call the sacrifice ratio, that if you're operating from higher levels, sometimes growth has to take a hit. Look at what happened in the US when Paul Volcker, broke the
Fair point.
There was a growth cost, but then look at the benefits of that over the next 30 years.
Okay.
What expectations got anchored? Look at the latitude that has given the Federal Reserve to act to growth shocks without worrying about inflation rising again.
No, I take your point. I take your point that there will be medium-term benefits if you're able to take the short-term cost. RBI itself says that the longer-term cost, cancelling everything out, is that if real interest rates are 1% higher, then the hit on growth on a longer term is 12 basis points. Now, I don't know, it just looks like too small an impact, but there are people who dispute that. Be that as it may, I want to ask Niranjan, you spoke very evocatively about inflation expectations of households. Everything that the Reserve Bank puts out, the inflation expectations of households are still running at 9-10%. It certainly has impacted forecasters like you guys. That inflation expectation has gone down. But Niranjan, have households really been impacted by this inflation expectation?
Yeah, so Lata, just if I can step back a minute and address something which Sajid had raised, or the question you had also asked Sajid about the growth part of the flexible inflation targeting framework. Now, if you look at both the monetary policy agreement signed between the Finance Ministry and the RBI, and you look at the amended RBI Act of 2016, in both growth is mentioned, you see. So it's not that the MPC has a mandate to look at only inflation. It's just a question of the balance. And, we know that to slip into some technical lingo, if the trade-off is convex, then in the initial years of disinvestment, the cost can be quite high. About the household inflation, I think household inflation expectations have trended down despite everything. Now, the question is, there are two things I would like to raise here. One is, as Sajid said, they still tend to be adaptive. They tend to be influenced very heavily by past inflation, especially of food. And that, in a way, gives us a sense of the credibility of the central bank's framework, you see. So perhaps that is still not built adequately, and people are looking at the past inflation rather than central bank's commitments about where it wants inflation to be in the future. The second, I think, is it's a question of how you look at the inflation expectations data, I personally feel that rather than levels, we should look at the direction of change, because we know that the inflation expectations, household, the surveys, that they're still, work in progress. They're not perfect measures of the inflation expectations. They tend to be overly influenced by some food items. So I would rather look at the direction of change, and that I still feel, Lata, that although there is still a gap between the household inflation expectations and the inflation target, the direction of change is still a positive.
I take your point on that. It's fallen by about a couple of percentage points in subsequent surveys, and therefore, yeah, it has impacted. And RBI also argues in that chapter, I think that's the second chapter, where they say that special forecasters are more easily influenced by, immediately influenced by RBI changing its stance. But households, it takes more time in all economies. So we are not an outlier in that. Maybe the Reserve Bank has to adopt a mission mode in terms of communicating, you think? You think perhaps widespread communication would help, Niranjan?
Yeah, Lata, so if I were to criticize the RBI in these past 5 years, I think one point of criticism is definitely that this new framework has not been adequately communicated. So, as Sajid said, it's a flexible inflation targeting network framework. So basically, you have a medium-term inflation target, which you have to meet, but you have the flexibility to respond to short-term shocks like we saw in the COVID time. So I think this flexibility has not been very well communicated, according to me. I think the second thing is I'm not saying so much among the experts, but general view is that this sort of ties RBI into some sort of inflation nutter position, that they look at nothing else. I think what the inflation targeting framework is essentially saying is that the repo rate, which is the main policy rate, is going to be used to target inflation and also respond to the output gap in the short term. It does not mean that the RBI is giving up its other goals, such as financial stability or exchange rate management. All it means is that the repo rate or the interest rate tool will not be used to deal with these issues. So for example, financial stability, you can use all sorts of macroprudential tools. For exchange rate management, you can use sterilized intervention in the foreign exchange market. So I think that's another point which is not adequately versus the flexibility part of it, that you can respond to growth shocks. And the second is the fact that it doesn't mean that the RBI gives up its other core functions. It just means that the interest rate is not used to deal with it.
I take your point. Maybe a little more communication will help. But on this repo rate, I have more questions. That is the only instrument the MPC has. And at a time, as we have seen, in all of 2020, when the system had to be flooded with liquidity, the MPC had no work at all. I mean, the overnight rate, the repo rate is supposed to regulate the overnight rate, but the overnight rate at some point in time was even 1 percentage point below the repo rate. So was the MPC rendered redundant? And how do you save it from such redundancy? Those questions to my guests after this break. Welcome back to this special discussion where I have been asking Sajid Chinoy and Niranjan Rajadhyaksha whether the Reserve Bank's mandate of keeping inflation between 2 and 6% has succeeded and whether it should be extended for another 5 years. So both of them have been vociferously supporting that RBI has succeeded and it is good to go for another 5 years. But the Reserve Bank itself, in its recommendatory note, has made some suggestions about the MPC. MPC has 3 RBI members and 3 external members. They're saying that the external members' term should be staggered. It shouldn't be all come at one time and go at one time. It will give a certain sense of continuity if they're given staggered timings. But I have something else to ask you guys. All that they, legislate on, if you please, or decide on is the repo rate. And at the moment, the repo rate is not at all material. So, Sajid, first that to you. Uh, I mean, I don't know how, you have to tell me, but how do you make the MPC relevant? I wouldn't be surprised if a number of external experts said, I don't even want to be part of the MPC, I have no job there, there's no work there.
Well,
How do you make it a relevant body?
Lata, I'll just take a step back and just finish one quick point of the earlier argument, because I think comes to the core of inflation targeting. When we look at household inflation expectations, the level is really not important, because you've got to judge the expectation compared to the current perception of households, which could be very different from what the official measure is. So as Niranjan said, look at two things. One is what is the trend, but look at the extent to which those inflation expectations are impacted by past inflation, as in how adaptive they are versus how rational they are. And to the extent that they're getting less adaptive and more rational, that's perhaps the best indication that expectations get anchored. One final quick thing, we had done some work a year ago checking to see whether headline inflation converges to core or core converges to headline, and we find in the last few years it's headline that converges to core. Again, more evidence that the framework is working. Now on the MPC, these are exceptional times. One of the reasons why the overnight money market rate is 10 basis points below the reverse repo rate is because you've had this flood of liquidity, and this is happening around the world, and so this is more exception than norm. I would think over time, as liquidity is gradually calibrated, the policy corridor will matter and matter meaningfully. Now it's a debate to be had whether the MPC should focus just on the repo rate or focus on the entire policy corridor, and therefore control the reverse repo rate. But to the extent that they can control the entire corridor and liquidity goes back to some modicum of normalcy, the MPC will effectively be impacting the overnight money market rates, which is the operating target of monetary policy. But can I say one more thing? I think one of the things that will be important, we've just finished the first 5-year term, so this is very much a work in progress. I think going to some kind of quantitative forecasts of MPC members, right? Some kind of dot plot of future interest rate expectations will be important. This whole challenge that central banks are facing is to try and develop more instruments to deal with more objectives, right? This is the full Tinbergen principle. And one effective way that advanced economies have found is, quite apart from the interest rate setting, to the extent that the FOMC or the MPC can give you quantitative state-based guidance. So you have a dot plot over the next 12 months or 24 months,
Yes.
contingent on what your current expectations of growth and inflation are. I think that can go a long way in actually increasing transparency, anchoring expectations, and preventing overshooting.
I take your point, and I think RBI is almost hinting that in the recommendatory paper, only they believe that it should be done after a lag, not immediately. They want forecasting tools to be better. Yeah, Niranjan?
Yeah, just if I can come on the reverse repo issue, I have a slightly different view from Sajid. And see, just in short, I think the MPC should have a say in the reverse repo as well, because I think when the committee headed by Dr. Patel was looking at the framework, at that point of time, the RBI had a very different liquidity management system, right? And it was committed to maintaining a structural deficit in the money market, because at that point of time, we were facing inflationary times, so therefore transmission was at the was being affected, etc. I think much has changed since then, and the RBI's own liquidity management frameworks or even practice, it's moved away from this structural deficit issue. So when you're structural deficit, by definition, the repo rate becomes the operating rate. But if you can have both, at times you can have a structural deficit, at times structural surplus in the money market, then the agencies setting interest rates should have some say in both ends of the corridor. But that's my view.
Okay, fair point. Both of you have suggested one change. You're saying that MPC should have a say in the reverse repo, Niranjan, and Sajid says that a dot chart of the MPC forecasting is also welcome. Now, I want monosyllabic answers. Yes, Sajid, you were saying?
I completely agree with Niranjan here. They should have a setting in the entire corridor. the upper end of the corridor, the repo and the reverse repo, but not liquidity. That given the speed and agility with which you have to respond to liquidity changes, that's something the central bank should control because that's a daily operation, whereas the MP should look at the entire corridor. So there's no difference here between what Niranjan and me are saying on the reverse repo.
Okay, I'm told I'm running out of time, but you'll have given me the meat of your suggestions that the 2 to 6% inflation targeting itself be continued. Not that that was up for discussion. The range be continued at 2 to 6, but both of you agree that perhaps MPC should have a say in setting the reverse repo as well. And as Sajid says, maybe some inflation forecasting as well in the form of a dot chart. Very quickly, would you agree, Sajid, I mean, and I'm giving you only less than a minute for it, that inflation targeting is going to be more important in the days to come? Maybe the easy days are over. Going by the way crude and metals and everything is surging, are the most challenging days ahead?
Well, every day is challenging, but the short answer is yes. What we're seeing is a big global reflation. And I think what's different about this global reflation is that this is not a synchronized global recovery, but increasingly we're seeing US exceptionalism. And what that means is if the US economy is going to outperform the rest of the global economies, both because you see massive fiscal stimulus and the US is vaccinating faster, you end up with a strange situation where you get a stronger dollar, higher global or US yields, and higher commodity prices reflecting the reflation. And this creates very uncomfortable trade-offs for emerging market central banks. So as India recovers, we're already seeing huge pickup in input cost pressures around the world. The temptation is going to be for firms to pass on these input price increases as final demand recovers. So the next year is going to be challenging, which is why I go back to, continuing with inflation target for many years helps you anchor expectations. And it's when you anchor expectations that central banks tend to have more latitude when output gaps pick up or you get a big reflation.
Got it.
Yes.
Sajid, I'm sorry I'm interrupting you because I'm told I'm out of time. Niranjan, we are now living at a time where you are at zero interest rate. Most central banks don't have even interest rate as an instrument to work with. At least we have something called an interest rate now. But do you think all this is going to change so dramatically that inflation and therefore meaningfulness of interest rate will come back?
Yeah, so Lata, first of all, I agree with Sajid that the next 5 years may be very different from the first 5 years because we basically saw a different inflation cycle. So it's going to be a tough year. But I want to just step outside the questions and just want to raise one more quick issue in terms of the operations of monetary policy under this framework, because we already mentioned the reverse repo and the repo issue. I think second is the inflation forecasting is very, very critical, you see, and in effect, this is an inflation forecast targeting system because what the RBI is doing because of lags, it's trying to move today depending on its forecast of where inflation is going to be 1 year down the line. And I think the record there has been,
spotty,
just middling. So I think the RBI needs to, before even going to dot plots, I think just taking a hard look at its inflation forecasting record because it is the intermediate target of the current framework. So you have to get better inflation forecasts as well.
Okay, I think that's extremely valuable feedback, especially since the Reserve Bank is very keenly looking to how it can improve the inflation targeting framework. But the key message from my experts and much watched experts is that the target should continue at 2 to 6%, but with the embellishments that they suggest that the MPC should also comment on the reverse repo, have a role in the reverse repo, that there's something called a dot chart which Fed members vote on. That should be incorporated in India, where the members forecast their inflation or their interest rate expectations. And of course, that RBI itself needs to improve its forecasting. That's it on this very special edition of Indianomics. Thanks for watching.